Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is a special edition of Market Today. We've got two very important macro data numbers right here with us. On the retail inflation front, we have the CPI inflation data that has come in at 5.72% as against the street estimates of about 5.8, 5.9%. And also we've got the IIP data as well, the industrial production data at 7.1%. That has also again surprised the estimates too on the upside. So it's a double delight. But how are the experts really reading these numbers, and what do we really understand from these numbers as far as the future course of the rate hikes from the RBI is concerned? Let's discuss all of this. With me joining in is Mr. Devendra Pant. He's the Chief Economist at India Ratings Research. Welcome, sir, and thank you so much for taking the time out for this discussion. Your first take on first the CPI inflation number 5.72% as against 5.88% on a month-on-month basis. Is it better than your expectations, and what do you think has clearly led to this fall?
Sakshi, thanks for having me on your show. CPI inflation trajectory is more on a expected lines. We were looking at both CPI and WPI coming in the month of December, both at around 5.7%, almost same. But before you or other people start talking about convergence, the convergence of CPI WPI is by chance, because the way these indices are derived and estimated, it will be by chance. But no doubt, it's a good news. And but if you look at, despite coming down below 6% in last 2 months, average inflation for this quarter is also in excess of 6%. So we have the 4 consecutive quarters of more than 6% inflation. Right. All of us know that the impact of monetary policy on cooling off of prices starts with a lag, and generally there is nearly about 3-quarter lag before the monetary policy starts showing its result on price control. So going forward, we expect the prices will now in most of FY24, so remaining 3 months of this fiscal, January to March, will move gradually. It is unlikely that they will fall sharply. During full FY24, it is expected they will move in mostly in 5.3 to 5.5% range. What is in store for monetary policy in February? Although the budget will be one of the major input which will go into the monetary policy decision. However, we still believe there may be another 25 basis point rate hike, because inflation is not yet come down to the RBI's target of 4%. So another 25 bips hike, most likely in February. And post that, we can see a pause on the rates. Unlikely that RBI will move quickly to the easing cycle. So rates may remain at 6.5% range for some more time.
Okay, so the rates may continue to inch up higher because inflation still is not yet eased to about 4%. But, still 2 months in a running row that we have seen below that 6% mark finally after a long haul. But how happy should one be really with this headline number? Because if we look at the core inflation number, that is still trending higher. It's come in at 6.1%. And last time from the RBI governor statements, we did read that, they would be very hopeful once the core inflation data also comes down as well. So your thoughts here as to how concerning would be the current core inflation data, and how much of an overhang would that continue to have on the RBI's aggressive stance on the rate hike front?
Well, Sakshi, the core has remained stubborn. Now, generally what happens, the core inflation rises when there is strong demand in the economy. But as on today, as we see, the demand is not that strong in the economy. There is demand. There's a demand for commodities or the items consumed by upper income bracket. But the demand at the lower end of the pyramid is not there. It's not that strong. Now, core is the one which can be targeted by the RBI. But worrying trend on today's inflation number again is more than 13% inflation, 13.79 to be precise, for cereals and products. And cereals and products is the one which constitute a larger share or budget share of the people at the bottom of the pyramid. Now, how it is panning out? If I look at uh, in December 21, cereals and product inflation was just 2.62%. From there, it started rising, inched up to 6% in April, marginal decline in May, but post that, it is increasing. And since September, last 4 months, it is in double digit. It started
Absolutely.
with it started with wheat export. Wheat export was banned. There were news of monsoon rainfall, especially in the Gangetic Plain, not being up to the normal. Then the prices start rising. We had seen the services. The Rabi crop is expected to better. So hope when the Kharif crop arrival starts coming in,
Yeah.
we may see a cooling off of this inflation. Another point which I would like to mention
Sure.
is what we had seen in last 2 months when the inflation has gone down below 6% is the deflation in vegetable prices. So November deflation was of 8%, and if you look at this month, December, deflation is 15%.
Correct.
Going forward, like in the winter season, always the fruits and vegetable prices comes down. But
Yeah.
if with the increase when the vegetable prices start rising during summer as we enter summer, if cereals prices doesn't come down, and along with its stubborn services sector inflation, so the central bank is unlikely to lower its guard in its fight against inflation. So that's why we are saying even February also there are chances of 25 basis point hike in the
So
policy rates.
what would you estimate as the terminal rate after that 25 bips hike? Would that be the terminal rate that you expect from the RBI?
As of now, it appears it could be a terminal rate six. So terminal rate could be 6.5 to 6.7, depending on, because what RBI will be looking at. This is the last inflation print they have today, right? On the consumer inflation, and on Monday you will have the WPI print. Now, the way WPI has declined, again, it is again like expected that as I said earlier, the flattening out. So WPI may also flatten out. Now, falling inflation, although is a good news for the government because they will have their time and energy spending on the other aspects for the economy rather than just worrying about inflation.
Yeah.
But when the inflation goes down, government through its salary growth will be slightly lower. But the inflation coming down, we expect the second half, if you look at NSO number on the first advance estimate,
Right.
second half GDP growth is expected to be less than half of first half, so 4.5%. And then your inflation coming down, so your nominal GDP growth in the second half this year, and then going forward in next fiscal year will be much lower. And the lower GDP growth means, if you look at the corporate balance sheet, their EBITDA margin growth will be lower. Lower EBITDA margin growth means lower taxes. So inflation coming down, good news. But if you look at use this number and see how the growth profile for next fiscal is going to be, what the inflation profile next fiscal would be, and based on that, what kind of nominal GDP growth we are looking at for next
Yeah.
fiscal, leading to that, what will be the tax collection or tax buoyancy? That's a bigger question as of now, which government and policymakers has to grapple with.
But sentiment-wise, will it be a booster for the markets tomorrow? Second month in the running, inflation cooling off, and will the data be looked at in a positive light by the economists like you now?
Look, how the market will behave or market will respond to it is beyond my assessment. But no doubt, the inflation print coming down by 16 basis point is a good news. Going forward, the monetary policy action or impact will start coming in, and that will cool down inflation further. So, for an economy, the higher inflation is mother of all ills. It's the biggest risk. The moment inflation goes up, if it is not brought down, unfortunately, we have the fiscal position is not very good. We still have 6.4% of GDP as the fiscal deficit for the union government, because the fiscal policy, impact of fiscal policy on inflation is instantaneous. Whereas the monetary policy takes a lag of 3 quarters or so, fiscal policy impact is instantaneous. You adjust rate, you cut duties and all those, you will see immediate result on the fight against inflation. Since we already have a higher fiscal deficit, so
Yeah.
government's hand are a bit tight on that end. So the monetary policy has to take that action. So I think a market will take it positively. Yes, there may be that if the market was expecting, but as you were saying, the street estimate was around 5.8 or so, and number came lower than that. That will be most likely be cheered up by the market.
Absolutely, and that's the hope. On the other hand, it's a double delight because India's November IIP growth has also come in at 7.1%, and that's the highest in 5 months that we have seen. And this is versus the contraction that we had seen in the month of October that came in at minus 4.2% for all our viewers to know. India's November IIP's growth is also above the consensus estimate that we were looking at from the street of about 3 odd percent, 3 to 3.5% is what the consensus was coming in through. Your first take on the IIP growth number as well, and is it above your estimates too?
Yeah, IIP, we were expecting it to come somewhere around 5 odd percent, but it has come better than our expectation also. They'll be a bit perplexing because if you look at the October number, now Diwali was in November. Generally, October is the period. September, October is the period when the retailer will stock up goods for your Diwali sale. So the festival demand has been bit muted from the production side. Now there are two ways of looking at this number. A, either whatever was produced earlier, they were not able to sell and there was a lot of inventory. So whatever festive demand, in that festive demand, the inventories were cleared and it's a restocking taking place. But one thing we should be very watchful of, like if you look at November 2021, the index in October 21 was 135, which fell to 128 in November 21.
Yeah.
And on top of that, we have grown 7%. Now, again, we have reached a situation where we are marginally higher than the pre-COVID. So pre-COVID, February 20, IIP number was 134. So we are higher than that number. We have what we had seen in the past. We have reached pre-COVID, but within a month or two, we again go back to a level which is lower than the pre-COVID level. So is the demand is an issue? Is the demand is strong enough, or the demand is still fragile? And as we discussed, like top end and bottom end of the pyramid, the people are still dependent on PMGKAY. This means the purchasing power has been eroded significantly. Now, how quickly those people comes back. Now, one good thing which is going to happen, which is when the inflation comes down, the real wage growth of people at the bottom, that will come in the positive territory. So when
Right.
the inflation was 7% and the wages were growing 6%, they were minus 1% real wage growth. Now, if
Hmm.
the wages are growing at 6% and the
Hmm.
inflation comes below 6%, then you have the minor real positive real wage growth. And if that continues, that will be a major demand booster for the economy.
True. Let's also break it down further. For the IIP, we've got some other numbers like manufacturing sector's output has grown 6.1% this time. The mining output has grown by 9.7%. Power generation has increased by 12.7%. And the capital goods space has actually grown by 20 odd percent, right? There's a sharp up move over there too. How do you look at these, breakup of the numbers so far that we have? The heavy lifting being done by most of the industrials over here. Is that going to be the trend going forward from here too?
Look, Sakshi, the goods is very notorious. Notorious in the sense there's a huge fluctuation in the growth rate.
Yeah.
Now, I before taking this as a no doubt on the at the outset 7% is a good number,
Yeah.
but we have to be bit watchful of this, that this growth is sustained for a couple of months,
Yes,
because we had seen,
that's
as I
true.
said earlier, the growth comes and then it fizzles out, right?
That's true.
So so in the September we had seen 3.5% growth, and August was minus 0.7, so 3.5%. Oh, we are entering into the festive season, demand will be strong. But what happened? In October, consumer durable production contracted by 15%. I think this month, November, consumer durable is positive. So this will be after 3 months of negative growth.
Hmm.
So I will not be in a hurry to term it as a revival.
Okay.
We'll still wait and watch for a couple of more months. No doubt number is encouraging.
Hmm.
And if the trend continues, so minor recovery, or if it is nurtured or supported by some policies and other things, whereby we can see people at the bottom of the pyramid, those who have marginal propensity to consume closer to one. So for the non-technical viewers, so marginal propensity to consume is nothing but if people have 100 rupee additional income, what they will do, how much they will consume. So we had seen people at the bottom of the pyramid, if they have 100, 200 or 500 rupee additional income, most likely they will consume the entire amount.
Right.
And what it
Just
does
yeah,
is,
yeah.
yeah, so you have more demand coming in, capacity is being utilized, and the capacity utilization increasing. And if it's sustained, then we can think about a sustained investment recovery, which is required for sustained GDP growth.
Absolutely, well noted that point. But just for a wider range of audiences who are watching this show right now, for the common man to really understand, this double delight, we've understood it from the economy point of view, what it does to our economy. But for them, how soon will this lower inflation really reach their pockets? How soon will they start to feel an easing in their day-to-day purchases? And from the industrial point of view as well, for the IIP, what do they really see as a change around them? How soon will that change come about, and how will that impact their daily lives?
So, Sakshi, inflation coming down doesn't mean the prices have come down, right? So, when we say the inflation, it is rate of change. So, yes, till till say October, the prices were growing at 6% over last year. Now prices are growing at a rate lower than 6% this year. Now, for a layman, now I'll not purely look at just how the prices are growing and how the IIP is growing. I'll put it at along with how their wages are growing. Now, even if the inflation is just 4%, but their wages are growing just 3%, they are worse off compared to the previous year. Now, if the the wage growth at the bottom of the pyramid, whether we say the agriculture laborer, whether we take the government notified rates for the construction worker, right? They were growing around five odd percent. Now, when inflation was more than 6%, so they were able to purchase lesser goods compare with their wages compared to what they were purchasing earlier. Now, even the wages growing at the same pace, the inflation coming down by 1% or 1.5%, and going forward approaching 5%, which is the RBI's target, because they have said they don't want to go to 4% at one go, because that means killing the demand totally in the economy. So if the inflation in next fiscal remains somewhere around 5 odd percent, between five and a half, and the wages growth continues at the 6%, they are relatively better off compared to this year. And
Okay.
that will have some kind of demand impetus to the economy. So for a
All.
common man, watch out for inflation and watch out to wage growth. The day the wage growth is higher than the inflation,
Yes.
then you will see some kind of spurt or some movement in the demand. So that is what has to be watched for.
All right. Well, on that note, Mr. Pant, thank you so much for being with us on the show and breaking it down very simply for all our viewers to really understand this macro data of both inflation and IIP. It's a double delight, definitely encouraging right ahead of the union budget, which is just weeks away for the government on both these fronts. But the key question is, will this momentum be sustained on both these fronts as well? And how soon will we actually see the common man experiencing the benefit of the cool off in the inflation data into the prices as well, just like how Mr. Pant pointed out that we need to be watchful of these data points going forward too. Many thanks for joining in onto this edition. And thanks a lot for joining us on Business Today TV. Do stay tuned on to with us for continuous coverage on the news flows from the world of business and stock markets, all the updates from that front as well. And that can help you really decide as to how do you approach your markets and your investments going forward into the next trading session as well. Many thanks for joining in, and don't forget to stay tuned with us onto our other social media platforms, that's Facebook, Twitter, LinkedIn and Instagram as well. Many thanks.